We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of SRSrocco Report.com. How are you today, Steve?
Tom, doing great. I'm glad we're back again talking about one of my favorite subjects, gold.
Well, that's definitely one of my favorite subjects as well. But you have a unique way of relating gold to the price of energy. And really everything, as you're going to show today, is based on energy. So we have a bunch of charts here that we're going to go over today. So this is probably best viewed on YouTube, but we'll try to do our best to explain what is contained within all these charts. So with the first one here, Steve, what are you seeing and why did you want to bring this one up?
Well, I'm using Harry Dent Jr. as just an example. There are many out there who are either have bullish or bearish forecasts for gold. And what they do is they tend to look at gold and use different metrics, whether it's debt, whether it's the money printing or the money supply, or technical analysis like the cup and handle formation. Or some people use, the funny thing is they throw goat entrails against the wall. They try to see where, what the pattern's going to be. But back in 2019, Harry Dent was famous for putting this chart out. And he says that if we look at this chart, it shows the chart of gold going up to its peak in 2011. And then it's been falling. And then he says it didn't break above 1525. And so his forecast, it would go back in 2020, 21 to 1,000, and then maybe 700. And then possible it would go back to its bubble origin, which started in 2005 in the 400 to 450. And now and I'm just using Harry as an example. I respect his work, but I disagree because Harry is forecasting gold in an energy vacuum. And unfortunately, a lot of analysts just don't understand what's happening with energy and what it costs to produce gold. Because if you can't make a profit producing gold, then there is no gold supply. So we have to understand what it costs to produce gold. So if gold ever got down to 450, I can assure you that there isn't one gold miner, maybe one small gold miner that can produce gold for $400 an ounce. The entire gold industry would go bankrupt. So this is typical that I see continuing in the precious metal community, as well as other analysts. A lot of the mainstream analysts just look at gold, not how it's impacted by the oil price and what it costs to produce it. And that's how I differ from many of these analysts. Mm-hmm.
And, it just brings to mind that old saying of the cure for low prices is low prices and the cure for high prices is high prices, right? So it really brings to mind the idea that if it is not advantageous enough to produce gold at $400 an ounce, nobody's going to start producing gold. And that will make it therefore exceedingly rarer to be able to find gold, driving the price up, right?
Yes. And, I've talked about this during the pre-interview here, that if you look at the market, people, according to the Austrian School of Economics, the marginal utility of the prices of things, two people have to decide what that price is. And there's, but that's fine. But the thing is, the market, the entire global market is based on margins. Whatever it is, whatever good or service, if a company is selling something and they cannot make a profit margin, or an industry, then that good cannot be delivered to the market. So what is the foundation of our global economy is what it costs to produce things. Mm-hmm. And then there's a margin. And there has to be a margin for these companies to continue producing things and delivering to the market. So gold has a margin, silver has a margin, everything has a margin. Some margins are higher, some margins are lower, but that's how the markets work. But unfortunately, a lot of people want to forget these margins.
Mm-hmm. Yeah. And again, it just goes back to thinking about how many drivers there are for all of these different prices. And if you try to take everything into account, it becomes exceedingly complex, obviously. But when you think about the energy component being so critical to every single piece of the economy of producing any good, it seems like one of the most important and, let's say, hardest to forget, right?
It is. And I think I tried to continue to clarify, it's not just the energy, the diesel, the liquid fuel that the gold mining industry uses, or the electricity that is powered by natural gas or coal that actually processes the ore and refines it. That's just one aspect. You've got the labor, which is a big part, and that's labor from the people that are doing the work, and the management is a high form of labor. They get paid more. And then there's all the materials and the mine, and all of that actually is a combination of energy spent and burned through the entire process of building the mine, or the materials that it uses to produce gold. All those materials are the combination in the entire supply chain of energy that was consumed. Mm-hmm. And so when you understand that the good that is being sold, the major component, when you add it up to the entire supply chain, is energy in all forms and stages. Mm-hmm. So that's why the energy is the number one driver of the economy, and it's the number one factor that determines the prices of things.
Mm-hmm. All right, Steve, let's move on to the next chart here. We're going to get to margins and, a couple news stories and stuff later in the interview. But what is this, when we think about the growth of money supply, how did that drive gold prices?
Well, we could see here, even though the money supply has been going up kind of at a steady level, we're not seeing big bumps in the gold M2 money supply, which is in green, except when we had the pandemic shutdown. And so if you look at the gold price in 2020, it's going up similar to the M2 money supply. But unfortunately, or let's say, but not unfortunately, a lot of that M2 money supply ended up in the big banks. They purchased treasuries with that because that's what they're supposed to do with cash that goes into the big banks. And then what did the Fed do? The Fed took those treasuries and put it on its balance sheet. So a lot of that M2 money supply is held as a prisoner by the Federal Reserve. So it can't bounce around in the market. So it's gone. But if we look back in 1970s, we could see the gold price had two bumps in the from 72 up to 75. Then it went down, and then it went really up in 79 and 80. But look at the M2 money supply. It just kind of went up gradually. Mm-hmm. And then the gold price fell from the 96. You could see in 96, it was about 400, and then it declined all the way to the beginning of the 2000s. But the M2 money supply continued to go up. Mm-hmm. And then we could see in 2000, it started to go up in 2005, and it really shut up in 9, 10, 11. But look at the money supply. So we can't, some analysts are looking at the money supply as a gauge. I would say as you're adding more money supply, it's an indirect, because there are more dollars out there. But we could clearly see these peaks in the gold price did not correspond with the money supply. So my analysis suggests there's a different driver of the gold price.
So on this, Steve, would there be a difference of using M1 versus M2?
I mean, there is a little bit of a difference, and then there's M3, and then there's the MZM. But overall, you can see that the gold price shoots up, and it has kind of these ups and downs, and it doesn't really correspond with the M2 money supply. But again, there is more money supply in the system, and so then there's more dollars in the system. But also there's more people. There's a heck of a lot more people in the system since 50 years. And we have to remember, there's a lot of dollars overseas too. The euro dollar. It's not just the dollars that are in the US. There's a lot of dollars traded overseas. So we need to understand there's many dynamics. But again, to me, the M2 money supply isn't the real driver of the gold price. This is what I believe has been the driver, not only the gold price, but the silver price and the prices of most things, because without oil, you don't have an economy. And because the energy always comes first. So this is the average annual gold price versus the crude oil price. Again, these are average annual prices from 1970 to 2022. And we could clearly see in 1970, and there's reasons for that. I don't have the chart here, but from 1961 to 1970, even though we had the Cuban Missile Crisis, and then we had the Vietnam War, the price of oil did not fluctuate. It was $1.80. But with all these major events happening like we're seeing now in the world, it didn't fluctuate because we were adding so much oil that was coming on from the Middle East. I mean, a big oil supply. But then the U.S. peaked in 1970, and the U.S. was the major oil producer in the world, in the 1910s to 1940s. And so we could see in the white line is the oil price, and in the gold line is the gold price. So there is a distinct correlation between the increase in the oil price and the increase in the gold price. Because if the oil price, we have to remember the oil price was like $1.80 in 1970, it reached $36 in 1980. It's up 17 times. So if the oil price is going to go up that much, the cost to produce everything is going to go up, especially gold and especially silver. So we can see that and then we had the price move up, and I'll get into that in a minute. And then as the oil price fell and remained in this trend, the gold price did too. And it wasn't until the oil price really took off after 2000, we see the gold price going up too. Now, it's not an exact correlation. They tend to, there's other factors. Also, it's the cost of production. But what's interesting right now, we see the gold price has trended above the oil price significantly. Because back in 2010, 11, 12, and 13, it was above $100. And this is the Brent crude price. It was above $100. Now it's only at 80 plus. And the gold price is really at an average annual high. So the gold price is much higher than the oil price as a relative term. So,
considering that point, Steve, do you think that it's possible that the gold price is at all overvalued?
Well, you see, that's we could talk about that for an hour. Right now, we'll get into that. The gold miners are making very nice profits. While many in the precious metal community can talk about, all the paper gold contracts being traded, there are speculators that are doing that. They don't have to do that, but there are speculators. And then there are the commercial short positions. And so there's a trading mechanism. But the reality is, if we look at the Dow Jones 30 industrial stocks, they all have margins. And guess what? The top gold miners actually have better margins than a lot of the Dow Jones industrials. They're making more money than the Dow Jones industrial stocks. Well, if the price of gold was really manipulated and the miners were not making money, I would say, okay, there seems to be a factor there. But the gold miners are making very good profits right now, and they're giving a lot of dividends. And so this is an aspect that the industry is kind of overlooking. But there are other dynamics we can talk at the end of this interview. But right now, the gold price, there are very good margins for the gold mining industry, and they did not have those several years ago.
Do you want to get into margins right now, Steve?
Well, yes. What I'm showing here, we've got the brown area. That's the West Texas Intermediate crude oil price, and it only goes back to 1983 on stock charts, unfortunately. But and then there's the gold price, the same thing I've shown before. Now, what I've done, if we look at the prices in the black, we see in 1970 these three prices in the 41, 276, and 300. Those are my estimated break even for homestake mining to produce gold. Now, the next four, which is in 2000, 2001, 250. And then we've got these other three. Those are based on Newmont and Barrick. They're pretty good gauges. Some companies are higher cost, some companies are lower, but it's a pretty good gauge. So if we look at the gold price back in 1970, we see that it took Homestake Mining about $41 to produce gold. And the price in 1970 was 40. So they actually were losing money. Then we see the big move at price up especially in 1979 and 80. But Homestake Mining's cost over that period from 80 to 82 was $276. So you know what happened after the big price spike? In a couple of years, the price of gold came back down to the cost of production or close to it. And then it tended to consolidate and go up and down. And then in the early 90s, Homestake Mining was producing gold at about 300. They're still making profits. And then as the oil price really declined in the late 90s and early 2000, it got down to $14 a barrel in 1999. Barrick and Newmont's cost of production back then was about $250. And then we had started to get peak in conventional oil production. And we could see in the brown line, look at that brown line. We see the oil price went up to 140. Well, if the oil price is going to go up to 140, it's going to impact what it costs to produce gold. And I'll show you. And so we see the gold price move up, and then we had the big correction in 2013, and then it fell down to its low in 2016. And the oil price at that point in time had got down to the 30s, 40s. Well, the break even, my estimated break even for Barrick and Newmont was about 1,050. So sorry to interrupt you, Steve. When the oil price falls back down like that, like we can see, basically after 2014 or, even in the 90s here, why does the cost of producing gold not come down significantly along with the price of oil? Well, you see, this is because over the 40 years, let's go from 1970 to, let's say, 2011, all that gold was produced, all those high quality reserves are gone.
Okay.
And so now I have a chart showing the average ore grades of the gold mining industry. It was cheaper. It was much cheaper to produce gold back then. And so now, of course, there's inflation, right? We have more money going into the system, and that's part of the issue. But as a form of reference, if even though the oil price has fallen back down to 40, not too far off of what it was, right? 36 in 1980, but Homestake was producing gold at such a high rate per ounce per ton. Now the gold mining industry is down to 1.5 grams per ton. That's it. 1.5. It's basically gold dust. And what you have to do, it was more, let's say, underground, high quality veins. Now it's open pit, and we're just churning. We're sending in these massive haul trucks. We're churning through millions of tons of ore to get very little gold, and that costs an arm, leg, and a foot. And so now, if you look, each time gold has gone up, and then in we see 2018, 19, the increase to 1150 as the oil price went up, and now my estimated break even is about 1350 for the top gold miners. So we see the margins are look how the price of gold. This was a few days ago, 1818. Look at the margin for Barrick and Newmont. They're making a lot of money. So the idea, can the gold price come down? Let's say there's a slowdown in the economy and inflation does moderate. Well, then, yes, the margins can be reduced. I'm not saying that's going to happen, but we shouldn't be surprised if it does on the short term, because the energy dynamics are really going to change in the next several years. That will make this whole dynamic of the gold price change to much higher prices.
And that kind of goes back to the energy EROI, the energy return on investment for producing that gold at that point that you and I have talked about before in other interviews, where the energy return on investment for, let's say, the unconventional shale oil just becomes so high that at a point it becomes less productive to actually go after that oil because you're spending so much oil to get it.
Yeah, we're not ever going to run out of oil. Mm-hmm. The issue is what oil is economically viable, and then how much. We have to remember there's one thing about having there's the energy return. Charles Hall said that the energy return on investment, let's say if oil was 3-to-1, which is less than the oil sands of 4-to-1. That's what you get. You get energy return on investment of 4-to-1 from the oil sands. If we only got 3-to-1, that's all we had. That means we could only have highways and then make cars to drive on those highways. That's all an energy return on investment of 3-to-1 would provide this global economy. Mm-hmm. We couldn't have entertainment. We couldn't have education. We couldn't have hospitals. We couldn't. You need all those profitable energy return on investment of barrels of oil to allow all these different aspects of our economy to happen. And that's what is missing from the idea of the energy industry having a higher oil price. It doesn't matter. It matters what the energy return on investment is. Mm-hmm. So in conclusion, I just wanted to show that the reason why these analysts like Harry Dent Jr. Are able to make forecasts that are kind of, to me, they're out from left field to show that the price of gold can go down to 400. Well, of course, if no one buys gold, Tom, then the price would be zero. There'd be no demand. Mm-hmm. I get that. But there is demand for gold. If there's demand for gold and there's supply and they're kind of, the supply and demand are somewhat even, then what do you go by? You go by the cost of production. And you cannot produce gold now for $1,000. Mm-hmm. You can't produce it for $700 or $400. And so if people want to have gold, they're going to have to pay what it costs to produce it. Mm-hmm. And that's what it comes down to.
To incentivize the miners to actually go out and be mining it.
That's correct.
Mm-hmm. So this chart was interesting to me. You had sent me these a little ahead of time, and I was looking at it and thinking about how we can parse out, and we'll show the following chart will kind of give a little bit more clarity here, but the actual operating costs, Homestake's operating costs. And I was wondering if we could kind of pull out how much the oil chart affected the operating cost.
Okay, we can do that next. Mm-hmm. The thing is, we have to understand Homestake's operating costs aren't increasing because the management's decided, well, we're just going to pay a lot more money for what it costs to produce gold. I can assure you all operators are trying to get the best prices for what they're doing. And so what we're seeing here is I've shown in the prior chart how the oil price went up, and there's a reason for that. Well, if you look at the Homestake's operating cost, which is in the green line, and I've found out this information by looking at their annual reports. We could see back in 1971, their operating cost per ounce was $41.21, but the price of gold was $40.80. So they actually lost money. And then we could see as the price of gold went up to $159 in 1974, their operating costs were $110. Now let's look at 1975. Gold had quadrupled. $161. So, somebody in the market who has no idea what it costs to produce gold is saying, wow, the inflation's going up. Look at the price of gold. It's quadrupled. Some, like maybe Harry Dent, would call this a bubble. Well, it's not a bubble if now Homestake Mining's operating cost has tripled from $41.21 to $127. And why did it triple? Because the price of oil quadrupled. And that's the reason, if the energy is going to go up, like we're seeing now in Europe, prices are going up everywhere. Food, everything goes up because energy is the main factor that produces these things. Mm-hmm. So now it's interesting, in 76, the gold price had a correction, right? Went down to 125. Well, Homestake didn't make it. They lost money in 76. Mm-hmm. And if you look at from 1971 to about 1977, they really didn't make a lot of money. They made some good money in certain years. The real profits happened in 79 and 80. So the $613 gold price in 1980, I think the high was $850 for a few minutes, but the average annual high was $613. Their cost of production was $276. Look at the margin there. And so when inflation was no longer going to continue up exponentially, right? Because nothing goes up exponentially and just continues. It's going to mean revert. And it reverted. And still, when the gold price came down to $376 in 1982, look at the operating costs here. They were still making good profits. So we could see in 1981, the gold price was $460, but Homestake's operating cost was $322. It had increased 8 times, about 8 times. So if its cost is going to go up 8 times, well, the gold price has got to go up. Because then if the gold price remained at $100 in 1981 and Homestake was producing at $322, they'd go out of business. So we need to realize if the market is demanding gold and supply and demand are somewhat balanced, then you have to go by what it costs to produce them. And so this is, we have to understand that's the way it is in the entire market. And that's what I wanted to show, that these gold prices going up were not because of just inflation or because people were betting on higher prices. There was some method to the madness, and that was the cost to produce it due to the high oil price. Now, this is a close-up of what I just showed you. And the reason why we saw the price of gold move up, because we had, first of all, the United States peaked in oil production. And then we had the first oil shock from Saudi Arabia, the oil embargo. And that quadrupled the oil price. And of course, the oil price is going to go up. It's going to cost more to produce gold. And then we see a kind of a consolidation from 1974 to about 1978. And then we had the second oil shock, the Iranian Revolution. And Ayatollah Khomeini took off 4 million barrels of oil. And then the price of oil tripled again. And that's in 79 and even up in 80. And this is the reason why we saw the big increase in the price of gold. So the oil price increased 20 times from 1970 to 1980. We see the 180 a barrel to $36.83. The gold price went from $35.94 to $612 or $613. So there is a reason why the gold price went up 17 times, because the oil price went up 20 times. So, and then as the oil price subsided in the following years, the gold price came down as well. So I'm not saying it's a direct relationship, but this is a much better factor than the money supply or the M2 money supply or the debt or whatever, because if energy is the number one driver, then energy dictates the price of goods and commodities and metals that are delivered to the market.
So I remember the last time you and I spoke, Steve, that you were saying that the price of energy as we approach the energy cliff will become far more volatile. And as we, theoretically, as we start running out of easier and easier oil to be able to produce, that will over time drive the price up, which accordingly you're saying should drive the price of gold up.
Yes, but there are two different dynamics, and at some, maybe in another interview we can talk about the gold and silver prices, because they are money. Even though silver is more, as an analyst say, it's an industrial metal. That's actually a good thing. The reason why to own silver, because a lot of it's gone. But when we hit the energy cliff, there's a different way to value those. But right now, as we're still approaching that energy cliff, and the price of, like we're seeing in natural gas in Europe, is going up because they're the most affected, because they import the most natural gas. And when there's shortages, they're the first in line to have disruptions and high prices. Mm-hmm. But as that moves throughout other countries and regions, we will see higher oil prices. But you know what the problem with really high oil prices, like we're seeing with high energy prices in Europe? They start cutting chunks of the economy get shut down. Mm-hmm. The industry is shutting down parts of the industry in Europe because of the high natural gas price. Mm-hmm.
Well, it's interesting to think about the dynamics of how energy really affects all of these other pieces. So, for example, I had a guest on a couple months ago. I can't remember his name, but he's Pinecone Capital or something like that. And he was saying that, a perfect example of this for right now, or the one that came to mind, was that when China kind of foresaw their lack of energy as they're coming into this, they started, warning their citizens to prepare themselves for a colder winter with less energy to go around. And they also got rid of all the Bitcoin miners as a preemptive way of trying to save some of the energy that they do have and keep it for the other industries that they have, right?
Yes. And, this is a dynamic which is like a whole different interview, because the world, especially China, has built up this high-tech global metropolis. And each year you add more business, more infrastructure, more buildings, more warehouses, and that need to maintain a certain amount of energy to run them. Mm-hmm. Well, you can't go back. You can't go down, because then you start getting unemployment. A lot of this stuff doesn't function well. It goes bankrupt. Mm-hmm. And so if you can continue adding more energy, it's fine. But when you start getting into a peak of this energy and go down, then you can't maintain all this stuff. And that's going to be a big problem now. And we're starting to see that in Europe. Look at Uzbekistan. What happened with Kazakhstan with their crisis? Uzbekistan is not delivering natural gas to China. They stopped. They're going to keep their natural gas. Mm-hmm. So all these dynamics are just starting to take place, and they're going to get so much more interesting and unfortunately negative as time goes on. But I think we need to understand that it always comes down to the energy first. Everything, the money, the price of things are always a cause and effect of the energy. And unfortunately, when we hit this energy cliff, I don't see very high sustained oil prices. Because if you have very high $200, $300, $400 oil, mm-hmm. because there wasn't that much debt in the 1970s. Our debt in the United States has doubled from 14 trillion when we were $100 a barrel in 2011. It's now almost 30 trillion. Mm-hmm. High oil prices cannot allow you cannot sustain this debt, the interest payments on this debt. That's another factor. So there's all these different factors you can't just say, okay, oil is going to go to 300 and the cost to produce gold is going to be 2,500. So the gold price is going to go to 2,800. No, that's not going to be the fact. That could be. But the biggest factor is a lot of the financial assets and real estate are going to get in big trouble because energy are propping them up. Mm-hmm. And when people start moving into gold, they're moving out of those and into gold. That's a whole different dynamic. There isn't that much supply, mm-hmm. available supply for the 200+ trillion of stocks, bonds, and real estate to move into that. That's the other dynamic.
Right. That interview that I was talking about, that was Chase Taylor from Pinecone Macro Research. That's who was talking about that. But it's interesting. We have a chart to talk about how debt affects the energy cliff as well here a little bit later. So why don't we move on to the next one? And this goes back to what we were talking about earlier about the margins of Barrick and Newmont, for example.
Yeah. Tom, when I first got interested in the precious metals, I focused like everybody else on, the interest rate, the debt, the money printing and all that. And I said, okay, this is the reason why we should be in gold, a hedge against inflation, a hedge against the collapse of the US dollar. Well, all that's going to still happen. But I was wondering, why is the price of gold going up? And what does it cost to produce them? So I reached out to one of the major accounting universities, and it's in Texas. And I asked, can you tell me, do you have any people that graduated that worked in the gold mining industry? And they actually sent me one person, and I emailed him, and he was actually the CFO of one of the gold mines in Nevada that was taken over by Barrick. And I showed him my net income approach of what it costs to produce gold. And he replied to me and said, that makes perfect sense. That's why the industry doesn't use it. And so I use an adjusted net income approach to get my production cost. And as we can see in 2021, my production cost is $14.56. That's my adjusted net income approach that includes all costs and taxes. It is less than that because their free cash flow is lower, but that's a whole different dynamic. The mining industry is not spending a lot on CapEx, and that's going to hurt them in the future because they're not going to have more reserves. But as we could see, if you go back to 2000, the orange bars represent the production cost. The dollar bars are the cost of the market price of gold. Well, there's no coincidence that as the production cost went up, so did the market price, just like with Homestake mining. But then when we had the big price move in oil, we see in 2011 and 12 that the average annual price was much higher than the cost to produce gold. And then we had the big sell-off in 2013. And then as the oil price fell and reached the low in 16, it did bring down the cost to produce gold. But then the cost has gone back up again, not only due to higher oil prices now, but due to the gold mining industry. Since in the last decade, they have gone through a lot of the higher quality grades, and it costs a lot more to produce gold. And so now it's at this $1,350 to $1,400. Mm-hmm. While the all-in sustaining cost is lower, a company that produces gold and they have a profit, they have to pay the tax. They don't get that profit. So the thing is, there's still a large margin right here in Q3 2021. There's still a significant margin there. Mm-hmm. So I'm not saying we're going to see lower gold prices. I believe we are. If we get a slowdown in the economy, inflation does subside on the short term into 2022, then investors will say, okay, then we could see the gold price fall, but we shouldn't be surprised if it does because it has done that in the past. Mm-hmm. But again, there are energy dynamics that are going to taking place as time goes on that are going to totally disrupt the market. And that's another dynamic.
So, Steve, when I look at this chart, what do you think that, the large margins that these miners are enjoying in 2020 and Q3 2021, what does that mean for the share price of the actual miners? Does that make that company as a share more attractive to investors?
It depends on the dividends, and Newmont is paying very good dividends. Barrick wasn't, but now Barrick is doing these cash out dividends, and they're sending like 500 million chunks out at a time to its investors, not in a dividend, but as an extra. But Newmont is paying very good dividends. And I think that's why Newmont's stock share price is actually doing better than Barrick. Mm-hmm. Their share price is also based on their operating margin. I call it their gross profit margin, and so if you plot their profit margins and their stock price, they go up and down with it. So if they're having very low margins, like in 15 and 16, their stock prices go to a low. Then as the gold price goes up due to more demand, especially during the pandemic, fear, then what happens is their profit margin goes up and their share price goes up because they're making more profits, earnings per share. And so this is kind of a dynamic. So we can clearly see that the gold mining industry, even though a lot of people in the precious metal community continue to say there's manipulation in the gold price, well, the gold miners are making just as good or better profits than the Dow Jones Industrials are. Mm-hmm. And so we have to understand That's kind of the way the market is looking at the gold price. I'm not saying it's right, but that's the way the market is determining the gold price. Mm-hmm. Now, Tom, in this chart, I kind of want to bring it back, go over 50 years to compare Homestake mining to Barrick and Newmont. So what this shows is the Homestake, Barrick, Newmont's operating margins based on different periods. Now, Homestake in white is based on 71 to 84, and Barrick and Newmont is 2000 to 2020. Mm-hmm. What we could see in the first chart on the left, the first bars, the average for the period. If we just average all their operating margins, mm-hmm. they're not that much different.
Not at all.
20% for Homestake, 24% Barrick, 21% for Newmont. Now, if we go to the peak, and this is their best year, and the best year for Homestake was 1980. It had a 55% profit margin. Well, let me tell you, if you're making a 55% profit margin, I mean, not many companies do that for a long period. Mm-hmm. Barrick was 51%, Newmont 44%. That was so actually Homestake had a higher profit margin. And now if we look at the quarter one, we could see that Barrick had 38%, Newmont 31%. So their profit margins are still pretty healthy. They're much higher than the average, because we have to remember the average between 20 to 24%, they had lower. They had 6%, 8%. So with their margins at 30% plus, they're doing very well. They're doing very well when we look at gold as cost of production and supply and demand forces.
Yeah, and this, I think, kind of goes back to our point about falling grades as well, right? It seems that Barrick and Newmont don't have, over time, it seems like Homestake was able to actually get a higher margin at the best of times, whereas Barrick and Newmont didn't, because, and that's very likely due to the falling grades, right? Or could be due to the falling grades.
Yeah, because Homestake was producing gold at a half an ounce a ton. Now, if you convert, it's a fraction of an ounce now, because there's 32 grams in a ton and now 1.5 grams per ton, where Homestake was producing it 15, 16 grams per ton. You're not moving as much ore. And these huge Caterpillar haul trucks that can move 400 tons, they're $5 million a pop. Mm-hmm. And then the tires have to be replaced almost every year. Mm-hmm. And those things are like 13 feet tall, and they're very expensive. And so when you figure you're just moving millions of tons of ore to get this gold, it just costs so much more to do that. Mm-hmm. And that's the falling energy return on investment of producing gold.
Did we have a falling grade chart in here, Steve?
No, I should have included one, but Homestake was actually bought out by Barrick. Mm-hmm. In the early 1990s. Barrick bought out Homestake. Homestake's ore grades were falling, and they no longer produce gold from South Dakota. That was their major mine. They started to diversify in other countries. But no, for example, when Barrick started producing gold in Nevada, in its Cortez and its gold mines, it was producing gold at about 7 grams per ton. Now it's down to about 2 grams per ton now over the 20-year period. Wow. And so that's fallen about 75%. Mm-hmm.
So this chart struck me as really interesting, Stephen. I have a question on it, but why don't you walk us through why you wanted to include this one as well?
I just want to give a frame of reference, because people say, well, I do think silver is underperforming gold. And we can clearly see, if you look at this chart, silver is in blue. It really went above gold in relative terms in the 1980s. So when someone says, well, if you look at the silver price on the top, and it looks like a cup and handle formation, right? Mm-hmm. So someone says, well, we got to complete the cup and handles. Like the handle has got to go back up to complete the cup and handle. Mm-hmm. Well, kind of the movement of silver was based on the price of energy. Mm-hmm. It wasn't because of the infamous cup and handle has to be completed. Now, it probably will, but the cup and handle came due to the price of energy impacting the value, the cost to produce these metals. Silver, for whatever reason, back in the 70s, just went up much higher in a percentage terms than gold did. Mm-hmm. And then they kind of were equal in 2010 to 12, but then we could see gold has outperformed silver. But one of the things we have to understand, if we go back to 1970, we see the gold cost was about $40. It's now $13.50. Mm-hmm. Silver, it was $1.50. It's now about $18. And these are my estimates. I'm going to do an update at the end of the year. But if you look at the lower part of the chart, the cost to produce gold has gone up 3,275%. That's what it costs. So I don't care how many people want to buy and sell gold. If I want to buy gold and there's supply and demand is balanced, well, I got to pay what it costs to produce it. And then there's a lot more demand now for whatever reason. So it cost 3,275% more to produce gold, but it only cost 1,100% more to produce silver. And so these are dynamics that the quants and the rocket scientists that were hired from college by the financial industry because they can make a lot of money. These guys design all these algorithms, and they're very intelligent people. So they I think they know this stuff. They go, well, why should gold go to 2,500? Yeah, yes, there is a lot of debt. There's more debt. There's all these things going on. I get that, and that's true. But if we just look at what it costs to produce gold, these guys have figured out, well, there's these big margins right now. And let's say they don't know about the energy cliff. They're going to go by this analysis. So when you hear JP Morgan's analysts come out and say, we're going to see gold moderate down by the end of 2022 to 1,550, we could say, oh, there we go again. JP Morgan, the big manipulators, they're coming out, they're bearish, they're the big bank. But if we just can't give some reasoning, with the margins being so high, it's not impossible to see these margins contract because they have in the past. Mm-hmm. I'm not saying it can, but there is some method to why these banks are putting out this, because if the banks believe we're going to have a slower economy, the inflation is going to subside. I'm not saying it will. I believe it will. But if it does subside, then we're going to see a different dynamic. So that's the reason why right now, if we look at the cost to produce silver, there's a 27% margin. And if at 1,350 gold, there's a 35% margin. Those are good margins because just a few years ago, the gold miners they weren't making a lot of money. Mm-hmm. And they are. And so just looking at this dynamic only and the way the market, I call it just-in-time inventory price mechanism, because that's the way the mechanism of the futures markets works when you're talking about consumables. But again, right. Gold and silver are not just consumables. They're also money and a store of wealth. So that's a different dynamic too.
Mm-hmm. So Steve, when I first looked at this chart this morning here, it really struck me that silver has basically broken away its correlation to the gold price since about 2013. So I was wondering if you had any idea why that would be.
Two reasons. I think the reason for that had to do more with the inflation scare in 2011, 10 and 11, similar was to the 70s. And because the oil price had gone up so much. So even the banks are and I think a lot of the movement is the institutions and banks moving in because they have to hedge their bets and they have to, who knows where things are going to go. But I think the underperformance of silver has to do also with the crypto market, has siphoned away a lot of interest in the metals, has siphoned away some interest in the metals. And, Max Kaiser used to be a big believer in silver. Well, he's forgotten silver now.
Yeah,
he's totally forgotten silver. And so now when you move these billions and it is billions away from the precious metals into cryptos, it has impacted silver more, but I actually think that's a good thing if you're going to be a silver investor, because there's not that much more silver than there's gold in the world as an investment. And that's another interview on its own. And so, but still, if you look at the margins, they're not that much different with the gold and silver margins. They're off a little bit. Mm-hmm. And I think maybe this is the dynamics of the algorithms doing this. But when we start to reach this energy cliff, these dynamics are going to matter less. And that's why the metals are going to shine, due to they're becoming a store of wealth that the market, the psychology of the market has totally forgotten about.
Yeah, it's also interesting to think about, that maybe at different points in history, there are some possible different drivers, but it's really important, or drivers for the metals prices, but it's really important to remember the energy side of the equation and how that drives the price, right?
Yeah. And if you look at the silver price, you see it bottoms about 14 twice in 2015, and then it fell there during the pandemic shutdown. Well, 14, that was about the break even. Mm-hmm. We didn't see it go down to 6. You see, people are telling me, well, Steve, it costs $5 to produce silver because that's what it cost Hecla back in 2000. Mm-hmm. Hecla's not producing silver at $5 an ounce, even though they show their cash cost very low, mm-hmm. because they have so many byproduct credits that lower their cash cost. But if you look at Hecla as a mining company and what its profits are, it's not producing silver at $5 an ounce. Mm-hmm. And no, it would be losing money hand over fist. So the mining industry now, that's kind of a good understanding. That's the reason why I kind of bounced off 14. The demand, for whatever reason, the demand for silver in the market, we could say manipulation by JP Morgan, or investors just could care less about silver for that period of time, but it did not really go below the minimum what it costs to produce it. Do you know why? Because savvy financial guys running these algorithms at these banks would say, you got to buy now, because now the mining industry is losing money, and we could hedge that because it's costing more to produce silver than they're getting it. So we're going to buy that silver. Mm-hmm. And that's what a smart person, a smart financial guy would do. So that's the reason why you're not seeing the prices fall below the cost to produce things, because that's a deal of a lifetime.
And that was something that I was thinking about as well when you were explaining that, is the byproduct production of silver and how that plays into the actual cost and price rise of the cost of producing it.
It is true. About 70% of silver comes from base metal mining, which is mostly zinc and lead, and then copper, and then gold. The 13% is a byproduct of producing gold. Most of it is zinc and lead. But here's the thing. Those mining companies may use silver to supplement its balance sheet. But people say, well, they're producing it for free, so they could just give it away. No one gives away that. They use that to balance, to supplement their balance sheet. So we have to understand that the base metal miners, the copper miners, also have a minimum cost of production. And if they're producing some silver as a byproduct, they're going to use that to fortify their balance sheet. That's additional revenues. Mm-hmm. If you take that revenue away, they may be losing money. So we have to understand that's the way the mining industry works as well. And so, but 30% comes from primary silver mining. Mm-hmm. So if it fell below that $18, then a lot of that 30% becomes unprofitable. Mm-hmm. And if it's unprofitable for an extended period, then mines shut down.
Right.
Now, what I want to show with this is it's a Chandler levels. These are called different levels. And all I want to show is there are cycle highs and lows for gold. Mm-hmm. And It's basically kind of just a feel. And what I want to show is when the price of gold shot up and the high of the cycle high is its peak. And then it came down in 82, went back up, hit that midpoint on the dotted line in 82, and then it came down and hit the low, the cycle low. And then you could see it bounces off due to various reasons, supply and demand and cost factors. But then we could see in 2011, it hit a high, 1900. And by gosh, 5 years later, it hit its cycle low. The same thing it did from 1980 to 1985. It did that from 2011 to 2016. But we have to remember these cycles didn't happen because of goat entrails. The underlying energy price had declined as well. And sentiment, market sentiment, for whatever reason, the gold price fell. And this big decline here in the gold price in 2013, that was a lot of that was net outflows of the ETFs. And I just did an update on that. If we look at the inflows and outflows of gold ETFs, that has been kind of one of the drivers of the gold price. Mm-hmm. And I think it's going to continue to be a driver, and it's going to be even much better. We're going to see much big moves in the ETFs, silver and gold, due to institutions which drive the market moving into the metals. And where do they do that, Tom? They're not going to call up my local dealer and ask for $1 billion worth of Silver Eagles, because there isn't $1 billion worth of Silver Eagles. Mm-hmm. They're going to go on the ETFs and access silver and gold that way, because that's where they do that. And so this is the dynamic we're going to see. But now we hit another cycle high in 2020. And so does this suggest, in 5 years, we're going to hit the cycle low? I don't believe so. But I think there's a good chance we're going to hit that median dotted line of 16, 17, especially if we get a slower economy, lower inflation, lower prices. We're going to retest that. But as these energy dynamics continue to become more volatile, as we reach the energy cliff and go over by 2025, the demand for gold and silver are going to change, because there's going to be a lot of problems with the asset values of stocks, bonds, real estate. And I believe these financial guys and the market is going to start figuring that out. And that's what's going to be the main driver of the price, not the cost to produce them. Now, Tom, I wanted to show you this because it always gets back to the energy. I've been talking about energy in the late Bronze Age and the Roman Empire, which was wood fuel. As I mentioned, I believe I mentioned during the ancient Roman Empire at the peak, they probably cut down 1 billion trees to fuel the Roman economy in 50 years. And that was the reason for the downfall. They ran out of good quality wood. There wasn't enough wood to grow quick enough to replace it. This is the same thing with oil, because we hear about the roaring 20s. You hear that the roaring 20s. Some people are saying we're going to, these techie guys, we're going to have the new roaring 20s, in the 2020s. No, because we're not going to have the huge increase of oil production, because we could see this chart is the average oil production per decade. It's in 1,000 barrels. So in 1910s, it was 766,000 barrels a day. That was the average. Look what it jumped to, almost 2 million barrels a day in the 2020s. And if we look at the little chart on the left, that is the global car production in thousands. So it's really million. The United States in 1924, out of Detroit mostly, produced 3.6 million cars. Look at Canada, France, UK, Germany. It's a fraction. It might be 10%. And look at 1928. We produced 4.3 million cars, and the rest was about maybe 15%. Now, why did the U.S. produce so many cars? Because we were the major oil producer. In 1940, we were producing 71% of all the oil in the world. Now, if you're going to produce 3-4 million cars a year, what do you need? You need lots of new roads. You need highways. You got to put hotels on those highways and roads. You got to have restaurants now, and all the different support companies that are now moving food and goods to these restaurants and hotels and all the suppliers for the automobile industry. Guess what? It was all driven by that massive increase in oil production. So while there was American ingenuity due to this newly added oil production, if you didn't have the oil production, it doesn't matter how ingenious you are, you're not going to have the roaring 20s. And that was a one and done. And so I just wanted to show you why it's always been about the energy. And lastly, if we look at the 2000s, we saw that the oil production in the United States peaked in the 70s, and each decade it was falling. So we had to make it up with imports. And now, due to the big increase in the 2010s, even though we're producing over 11 million barrels, almost 12 million, the average for 2010 was a huge increase of 57%. You had to have the energy to get us out of the global financial crisis. Mm-hmm. You just can't do it with the Fed and Bernanke coming out with these, lower interest rates, and we're going to send, more money out there, or we're going to add debt. You have to have the energy to back it up. Mm-hmm. And we did. That's not going to happen this decade. I really don't see the world adding that much more oil this decade.
Right.
And that's the whole different problem. And that's why we're seeing such a massive increase in debt, because we're not going to have that increase in oil production, which allows increase of economic activity and GDP.
Mm-hmm. It's really interesting to think about the dynamics of how debt can pull forward demand and production as it pertains to energy. You and I have discussed before how the shale oil industry, yes, it produces, I don't remember the exact figure, several billion barrels of oil and condensates per day, but they're not able to do that at a sustainable cost, right? So this, I was just going to jump ahead here.
Okay.
Exactly as we're talking about it, this is a chart showing how debt pulls forward and affects the energy curve, right?
Yes. This came from a video of Nate Higgins, and he does some very interesting videos about energy in our future. The myth is the U.S. will be the next Saudi Arabia. Mm-hmm. Okay. Now, the problem is it doesn't matter if you believe in the Austrian School of Economics or if you believe in the M2 money supply or whatever. The resources of oil are limited. And you extract and produce the highest quality first. And we're in the United States, when we were producing oil in Texas and Oklahoma and California in the 1910s and 20s and 30s, you see the movie theater or the movie reels of the gusher. Well, this stuff came out under pressure and had a very high energy return on investment. It averaged about 100 to 1. Now, in like 2000, the U.S. energy return on investment of the oil industry was about 10 to 1. And shale oil is about 5 to 1. So the thing is, if you had no debt, if you just went by what it costs to produce oil and how much, and you continue to add more oil production, more fines like we had all over the world, then you hit a peak, and that's what the blue line is showing, and that's the peak with no debt. And then it's showing what happens as you decline. You reach this red line, and that's the natural decline of resources. And that's just the way it is. And unfortunately, even though there's a lot of oil shale in the world and heavy oil and methane hydrates, by the time you extract that energy and you refine it and you bring it to the market, its energy return on investment is so low, it bankrupts our high energy return on investment economy that needs a 10 to 1. So that's the problem. Even though there's trillions of barrels of that, we can't access it. It will not work with our economy. So what Nate has done in this chart is shown if we access debt, what the peak would have been here, the peak has moved forward, and we brought on more production, a lot more. We brought the production at a higher level, and what that is we have used enhanced oil recovery like they're doing in Saudi Arabia, like we're doing in the United States with shale oil, is we're using these enhanced oil recovery, which you need debt. And the shale industry was not profitable. That's why they added all this debt, and you can only do it with low interest rates. So by adding a lot of debt, the black is significant of this unconventional. It was added. So this is where the peak would be. So we still have more of a peak. We brought more oil forward, but this, except for the black area, most of the oil reserves are only going to be the reserves that we can extract. Mm-hmm. The issue is the debt has brought forward this production, and we've increased the amount. And the number in 2019, Tom, was 100 million barrels a day. We were able to increase the production up to 100 million barrels a day due to debt, due to these enhanced oil recovery. But what he suggests, where we would be without the debt in the red line and the red dot, this is where we end up. If you look at the red line with access to debt, there's not much oil left. Mm-hmm. We brought it forward. And that's why we hit the energy cliff. But before, without debt, there's a lot of oil on the other side. And so this is what is called the Seneca Cliff. It is a graphic representation. No, there's no X and Y axis because, unfortunately, Tom, a lot of the reserves in the world are fictitious. There's a book out by this gentleman, James Dietrich, who was an oil reserve engineer. And he says, his book, Too Much by Half, that the reserves out in the world, oil reserves, are inflated for various reasons, especially in the Middle East. So when you add all these things up together, there's going to be a shock to the market that we do not have the reserves that we think we have. Mm-hmm. And due to the falling energy return on investment and the access of adding all this debt, the downside of production is going to be cliff-like. Mm-hmm. And that is where we're headed.
Well, some scary stuff there, Steve. You recently sent me an article as well about how some believe that ExxonMobil is in danger of becoming the next Blockbuster or Kodak, implying that its resistance to embracing new green technology threatens its very existence. So explain to us some of the issues that you see with that thinking.
There's the mass psychology of the market. And, James Dines, who was famous being the original gold bug, he wrote a book on the mass psychology. And what's interesting, that's what's driving the market, the mass psychology. And a perfect example is the CIO, Christopher Alman of CalSTRS, which is the California State Teachers Retirement System, one of the biggest pension plans in the United States. He was interviewed a week or so ago on Bloomberg that Exxon is not doing enough to change its transition to green energy for whatever reason. And so actually, there's this, it's called these shareholders, they called engine number one. They have taken control of part of the board, and they want to make change. They want to force Exxon to transition to green energy. Now, I've said this before. If green energy was really a solution, I would be for it, but it's not a solution. Unfortunately, it makes the situation worse, which we're seeing now in Europe. And unfortunately, I think that's going to get even worse. So CIO Ailman is overlooking $320 billion of assets on its CalSTRS investment portfolio. Here's what's interesting. If you're an investment portfolio and you are representing the public teachers as a safe investment portfolio for the retirement, what should you be in? You should be in safe assets. And what are safe assets? It's fixed income. It's treasuries. Tom, they're almost 50% in stocks. And then they're in about 13% in real estate. And we know I think real estate's going to get into serious trouble, especially commercial. And then they're only 11% in bonds. And then they're about 11% in private equity. And that's a whole different animal that I look at. Private equity is devouring companies and extracting the wealth to continue producing a yield for the retirement system. And that's not sustainable. So the issue is, I find it interesting that CEO Ailman is his psychology of the market is we need to go to green, which really isn't going to work. And then what he believes are investments for his retirement fund, I believe are bubbles, and they are bubbles. And so, but that is a typical example. He's a typical example of what the market believes. They don't believe in the precious metals because they're just dead metals. They believe in technology is going to be the future. They believe in buying everything they can on Amazon. The savings rate in the United States shot up to a record during the pandemic, and the credit card debt fell. Well, guess what? In a year, it's totally reversed. Credit card levels are gone back up, and the savings level has fallen back to a low. So people want to buy what they can. They don't care about being frugal. But when the energy cliff hits, the mass psychology of typical of the CalSTRs, that is going to pop. Mm-hmm. And that is when I see these institutions are going to have to be forced to protect the wealth for their retirement as best they can, because you can't continue to grow with energy scarcity. So that's when I see the institutions moving into the metals, because they're going to have to protect wealth as best they can. And that is a mass psychology change that is coming.
Yeah, they're going to have to find somewhere to, like you say, protect all that wealth. Steve, this was a really in-depth look at how energy really affects all parts of the world. And I thank you for that. Of course, you're available. Your website is SRSrocco.report.com and at SRSrocco Report on Twitter. Steve, do you want to leave our audience with anything else before we wrap up here?
Yeah, there was one chart we were going to show, and I just want to make sure people understand the idea that why is fiat money worthless? Well, it really comes down to the energy. It's not because, well, what does the money give us value? How you could trade, money is currency. Well, it is. But the reason why fiat money has no intrinsic value, because 13 $100 bills cost $2.60. Mm-hmm. And that's because it's very expensive, high quality, anti-counterfeit $100 bills. You could probably produce 13 $100 bills for about a dime or 15 cents, all of them. But we produce $2.60 of $1,300 bills, which is what the gold mining industry, when I did this, that's what it costs to produce an ounce of gold, $1,300. So 13 $100 bills can buy you an ounce of gold, but the treasury, it only costs them $2.60, because that's the energy cost in all forms and stages to produce that $100 bills. Mm-hmm. And that's the reason why fiat money doesn't have any intrinsic value. It doesn't take much to produce it, mm-hmm. but it costs $1,300 to produce that ounce of gold. And that's why fiat money doesn't have any intrinsic value. So I just wanted to share that, and that it all comes down to the energy. Mm-hmm. You can quantify it. So again, if we wanted to, the cost of a gold coin of $1,300, and if you printed $100 bills, you could produce $650,000 worth of $100 bills for 1 ounce of gold. The cost of 1 ounce of gold. That's
a cool way to kind of convert that. As you say, you've said before that gold is an energy equivalent store of value, right? And that's kind of puts it into perspective of why it has intrinsic value compared to, like the fiat paper money as we think of it.
Yeah. And in conclusion, all that fiat paper money that's in circulation, the currency in circulation, and then all the M2 money supply, those are, what do we call them? They're notes. So it's actually a liability. Mm-hmm. It's the gold isn't backed. The money isn't backed by gold. It's a Federal Reserve note. And if you have a note on your house, that's a liability. You owe that. So all this money is really a debt instrument. And how do you pay debts? You have to work in the future and you have to pay the debt back. Well, you can only do that is if you have growing oil production and growing economic activity to pay that back. That's the reason why currencies, fiat currencies, whether they're digital, whether they're fiat, and if it's a stock or a bond, it's all based upon burning more energy every year to keep those values moving up or at least stable. Mm-hmm. And that is the number one mass psychology that the market hasn't figured out, but it will. And that's the reason why investors should be owning the metals for the mid to long term. Mm-hmm. So I just wanted to end with that, just to kind of put it all together.
Absolutely. That's a great piece of perspective there, Steve. Well, I want to thank you again for a really excellent, broad conversation, Steve. And I can't wait till we do it again.
Yeah, maybe in a few months we can get back about the energy, because unfortunately, I think Europe, we may be in serious trouble due to the problems with the natural gas storage. So hopefully maybe in 2-3 months, we can see where things are at.
Absolutely. Thanks for your time today, Steve.
Have a good day.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.